On May 26, 2025, the United States lost control of $6.1 trillion in global trade, and not a single shot was fired. No explosions, no invasions, just a quiet directive from Beijing that sent shockwaves through the world economy. America never saw it coming. While Washington slept, China rewrote the rules of global finance. It started with a simple but devastating order. Chinese banks were told to ditch the dollar. No exceptions, no delays. Overnight, oil, steel, machinery, once priced in greenbacks, were now being traded in yuan. Trillions of dollars in deals slipped through America's fingers without a whisper. This wasn't a trade war. It was a financial revolution. Former President Trump had shouted across podiums, slapping tariffs on Chinese goods, demanding that Beijing play by Washington's rules. China's reply? We'll trade, but only on our terms. And those terms didn't include the US dollar. The world didn't flinch. It followed. Behind closed doors, the People's Bank of China made its move, raising the minimum yuan ratio in cross-border transactions from 25% to 40%. A bureaucratic-sounding shift? Not even close. It was a tectonic realignment. Chinese banks that failed to comply were threatened with isolation from capital markets. Compliance wasn't optional, it was existential. Bloomberg called it a monetary earthquake. Goldman Sachs warned that every 1% climb in the yuan's value could ignite a 3% surge in Chinese stocks. Evidence that the world's money was already moving. Then came the confrontation. At the Global Finance Forum, U.S. Treasury Secretary Scott Bessent took the stage, accusing Beijing of destabilizing global trade. He urged China to move away from manufacturing, to consume more and export less. But Beijing didn't just reject the plea, it flipped the script. China doubled down, reloading its made-in-China strategy with billions in AI, robotics, and semiconductors. Manufacturing, which already made up a quarter of its GDP, wasn't going anywhere. In fact, it was growing, on China's terms, in China's currency. The message was clear, this wasn't a phase. This was the new order. Markets felt it immediately. The global axis was tilting. Capital was shifting. The era of dollar dominance had begun to crack. In just the first 3 months of 2025, yuan-based cross-border settlements soared to 30% of global goods trade, up from less than 20% 2 years earlier. Analysts say moving just 10% more, roughly $610 billion, into yuan trades could ignite a 12% jump in long-term demand for Chinese assets. As capital floods eastward, liquidity drains from U.S. bond markets. Fewer buyers for treasuries, less demand for dollars. Tighter flows to Wall Street. Foreign institutions are beginning to hedge, not in dollars, but in yuan. But China's true advantage isn't just economic, it's strategic. Imagine standing in a shop in Johannesburg, buying a Chinese-made generator. Not in dollars, but in yuan. This isn't hypothetical. It's happening. In Q1 2025 alone, trade between China and BRICS nations hit 1.49 trillion yuan, roughly $29.7 billion, an 11.3% jump from last year. South Africa, Brazil, Iran, they're settling trades in local currencies or yuan, bypassing the dollar entirely. America's 145% tariffs, once designed to punish, are now pushing countries to walk away from the dollar altogether. And as the world adapts, the dollar becomes not only politically radioactive but economically inefficient. It's no longer just about allegiance. It's about survival. Exporters are waking up to a new reality. As U.S. officials bunker down behind a Fortress America stance, China's trade networks are expanding, rapidly, efficiently, and globally. The game has changed, and this time America didn't just lose control of the ball. It lost the field. Chinese exports to Brazil didn't just grow, they exploded, up 25.7% in a matter of months. Imports from Brazil into China surged even higher, jumping 30.1%, setting a new all-time record for bilateral trade between the two countries. But this isn't just a fluke in trade data, it's a signpost. A clear signal that a shift in global economic gravity is already underway. And it's not just Brazil. China's energy and machinery deals with Russia are booming. That's not an exaggeration. It's a structural trend. Reuters points out the underlying mechanics. Predictable pricing, fewer political strings, and yuan-based contracts that elegantly avoid U.S. financial scrutiny. In other words, China is offering what Washington no longer can. Stability without conditions. According to Lei Daoyang from China's Customs Department, BRICS countries, Brazil, Russia, India, China, South Africa, and now including new members like Egypt and the UAE, now account for 20% of all global goods trade. That's 1/5 of the world economy, and rising. These nations are no longer looking for permission from Western financial systems. They're building their own, and they're fast-tracking what economists once thought impossible: the de-dollarization of global trade. The irony? It's American sanctions that are speeding this up. The more Washington tries to weaponize the dollar, the more the world looks for a way out. So what happens when the dollar stops being the world's go-to currency? And who exactly has the most to lose? Let's rewind. In early 2025, former President Donald Trump returned to office and made good on a campaign promise, an aggressive protectionist swing. Tariffs on Chinese imports were hiked as high as 145%, a near unprecedented move. The messaging was clear: protect American industry, shield the economy, data Beijing. But that's not what happened. Chinese manufacturers, already battle-tested from previous trade wars and COVID-era disruptions, adapted swiftly. They didn't retreat. They recalibrated. They got leaner, faster, hungrier. According to Bloomberg, heavy machinery exports from China rose 18.4% in Q1 2025, even as China's domestic property sector stumbled. Industrial giants like SANY and XCMG shifted gears with stunning agility. Projects at home were paused, but rather than scale back, they turned outward. Global sales campaigns intensified, targeting markets across Africa, Southeast Asia, and Latin America. The strategy? Undercut the competition, slash prices by up to 50%, flood foreign markets, and lock in long-term deals in Yuan. The Wall Street Journal reported record shipments of construction vehicles across emerging markets, all priced in Yuan, completely bypassing US tariffs. This wasn't survival. This was an economic counterstrike. So here's the deeper tension. If Beijing can undercut prices and dictate the currency, what role does the US dollar play at all? By April 2025, more than 40% of BRICS trade was being settled in Yuan. That's up from just 29% the year before. According to China's central bank, this isn't just momentum, it's a transformation in motion. Countries like the UAE and Egypt are now signing multi-billion-dollar infrastructure deals directly in Yuan, bypassing the US financial system entirely. And a leaked draft cited by Reuters suggests something even more seismic. Saudi Arabia is exploring oil contracts in Yuan. Pause on that. If oil, the most globally traded commodity, starts moving in Yuan instead of dollars, it would be nothing short of a historic rupture. This isn't about cost-cutting. It's about insulating themselves from US sanctions. It's about independence. So ask yourself this. If China is offering faster settlements, fewer restrictions, and no political baggage, then who really has leverage in today's global deals? And now, behind the scenes, China is assembling the infrastructure to make this permanent. As of March 2025, over 60 countries are actively using China's cross-border interbank payment system, CIPS, a direct alternative to SWIFT. According to the Financial Times, transaction volume is up 27% year over year, and CIPS isn't just a payments network, it's a shield. It reduces exposure to the US dollar, and with it, exposure to US oversight. Meanwhile, China's digital Yuan pilot has expanded into 14 new trade zones. Transactions are lightning fast. Settlements are almost impossible to trace through Western systems. This isn't protest. It's design. Strategic, intentional, unapologetic. Every deal that clears outside of the dollar system is another crack in the foundation of US dominance. Not through confrontation, but through irrelevance. Which brings us to the final looming question. How vulnerable is Wall Street? Right now, US assets are seen as the ultimate safe haven. The dollar, the bedrock of global stability. But that entire status relies on one fragile truth, that the world needs dollars. What happens when that need starts to vanish? Goldman Sachs projects that every 10% increase in yuan-based trade could lead to a $210 billion annual reduction in foreign demand for US treasuries. That's not a slow drip. That's a fiscal hemorrhage. Bloomberg's bond tracker already shows a 12% drop in Asian institutional holdings of US government debt just in Q1 2025. And the moves are spreading. Central banks in Indonesia, South Africa, Iran, and others are quietly increasing their yuan reserves. The IMF's data is clear. This isn't just economic strategy, it's a loss of confidence. If dollar reserves no longer mean guaranteed stability, global capital will pivot, and fast. So what fills the void? Beijing isn't waiting to find out. It's building a parallel financial ecosystem, one deal at a time. From Africa to the Gulf to Latin America, it's already happening. The rules are being rewritten. Not in Washington, not in Brussels, but in Beijing. And if Phase 1 was reducing dependency on the dollar, Phase 2 could be a revolution. Leaked Chinese policy memos hint at a bolder move, tying the sovereign digital yuan directly to trade pricing. That would lock buyers into China's currency and bypass foreign exchange markets altogether. It's not just about convenience. It's a blueprint to re-engineer global finance itself. If that happens, we're not talking about a currency shift. We're talking about the end of the US-led financial order. Thanks for watching. If you're thinking this is just the beginning, you're right. The world is tilting quietly but rapidly. Drop your thoughts in the comments. Subscribe, share, and stay with us, because the next chapter could change everything.